Since the 2007 ANC elective conference in Polokwane, the South African economy has been on a downward trend. We've lost our investment grade status in terms of our foreign currency rating, and now are on the verge of losing our local currency rating. And in fact, in terms of private investment, we've lost a cumulative amount of 295 billion as local companies seek offshore opportunities in order to diversify their earnings away from South Africa. So it's no wonder that this upcoming ANC elective conference in December is quite high up on investors' radar, mainly because of the policy direction which it represents going forward. As the surname represents, unfortunately, Nkosazana Dlamini Zuma is seen as the status quo remaining and is hence negative in terms of an outcome for the market. Cyril Ramaphosa, on the other hand, in terms of the speech that he had on Monday, is seen as someone who's committed to driving economic growth, as well as putting the right people in place in order to improve the governance of state-owned entities. At this stage, the outcome seems rather binary, and we'll only know the results on the very day of the voting. But it's important to realize that in order to regain our investment appeal as a country, political certainty and hence policy certainty needs to come back on the table.
I run the Old Mutual Stable Growth Fund. The last couple of years have certainly been a bumpy ride for South Africans and for investors. From Nenegate to Pravengate, and then the disastrous medium-term budget, we've had quite a lot thrown at us. And it's not quite over yet. We've got the ratings agency decisions and the ANC election before the end of the year. I'm pleased to say that through this volatile period, our funds have done well. For example, the Stable Growth Fund has returned 11.6% over the last 12 months, and more importantly, over 1, 3, and 5 years is beating cash and its inflation target. The key to our ability to navigate these volatile times is taking a long-term perspective and building diversified portfolios. Two key long-term themes underpinning our portfolio positioning at the moment are our view that the global economy is recovering, what we call reflation, and secondly, that South Africa is in a period of stagnation. Global reflation means that corporate profitability is strong and global equities markets are doing well while bond yields are gradually rising. In our portfolios, we are overweight global equities and we have no exposure to global bonds. The second theme, South Africa stagnates, means that growth rate in South Africa has been trending down and fiscal and political risks have been rising. This has put pressure on the rand and bond prices. In our portfolios, we are at an overall level overweight rand hedge assets and we are underweight bonds and overweight cash. However, just because we take a long-term perspective doesn't mean that we can't take advantage of tactical opportunities. For example, last year at the beginning of 2016, the rand was simply too weak, and in the Stable Growth Fund, I significantly reduced my offshore exposure buying rand assets, taking the fund from 25% offshore to 15% offshore. That worked well, but as the rand has appreciated, I've been reversing that and taking assets back offshore. And that has worked well again this year as the rand has weakened again. As we head into the home straight for 2017, two events are looming large on the calendar for investors. The first is the rating agency's decisions on the 24th of November. The second is the ANC election of a new president in December. My base case is that either one or both of S&P and Moody's will downgrade South Africa's credit rating on the 24th of November. That is likely to lead to outflows from the bond market and weakness in the rand. Our fund is well positioned to weather volatility around this event, and we have cash available to invest in opportunities that emerge from the rating agency's decisions. Beyond the rating agency decision lies the ANC's election of a new leader. There are really two outcomes as far as the market is concerned. The one is Nkosazana Dlamini Zuma winning, which is likely to be taken negatively by the market, with the rand weakening and bond prices weakening. Our fund is well positioned for that outcome. The second outcome is a Ramaphosa victory with the rand appreciating and bonds doing well. Our fund is overweight rand hedges, and these will give back some of their gains into this scenario. However, our portfolio is well diversified, and we do have assets in the portfolio that will do well in this outcome. For example, we have an overweight allocation to local property companies like Growthpoint. These offer a dividend yield which is higher than cash yields and will also grow over time, so protecting investors from inflation. And they will do well and offset some of the losses in our rand hedge assets should the rand appreciate significantly. So as we go into the end of the year, I'm confident that our portfolios are well positioned and that we'll be able to navigate these two events, and that we have cash in our portfolios that we are ready to invest as opportunities arise. Thanks very much, and good luck for the rest of the year.